Hello and welcome to this week's episode of That Real Estate Tech Guy. I'm your host, Jordan Samuel Fleming, chairman of Smartphone. And this week we got a fantastically fun episode with my man, Jay Connor. Now, Jay Connor is someone I was introduced to recently because he is a specialist in private money. So this is another episode that's not as much technology focused as more real estate focused, but I thought it was really important to get him on because I'm always looking for how can I bring a wider set of knowledge to both our smartphone customers and the community at large. And Jay's got such a specific insight into private money. And he also, in this episode, he really does break down some of the bits around private money. A lot of people are kind of wondering, how do I get into this? I mean, I've done 1-2 deals. I want to do more. How do I get involved with private money? How do I get that going? What can I, how do I develop the right methods and processes to deal with that? And Jay really dives into some of this in the podcast, talks through some of the math that he focuses on and why, if you do the math properly and without emotion, then any deal will stack up for you, and the private money lenders will always be able to get their money out because, of course, they're covered by the assets themselves. So really fun episode with a really, really nice guy, Jay is. We also dive into some of the AI bits as well, bits that he's using and bits that has worked well, and some of the things he's tried out and hasn't worked. But it's definitely great. And also please do check the links on this podcast, because Jay has very generously given both a trial access to his course, as well as a free copy of his book and 2 tickets to his private money event conference that he's running. So there's a lot of really great and free gives that you can take from this. And we have Jay Connor to thank for that. So I'm going to shut up now and get right over to the show. Me and Jay Connor are talking all about private money. And I'm live with Jay Connor. Jay, welcome to the podcast. Why don't you give everyone a little introduction to who you are and what you're focused on?
Jordan, thank you so much for inviting me to come along and talk about my topic and subject that I'm so passionate about, and that's private money and private lending for real estate deals. The reason I'm so excited about it is because private money has had more of an impact on our real estate investing business here in Eastern North Carolina more than any other strategy. We started investing in single-family houses all the way back in 2003 here in Eastern North Carolina. In the first 6 years, Jordan, the only thing I knew to do was go to the local bank or a mortgage company to get funding for my deals. But all that changed in January 2009 after doing this for 6 years. That's when I learned about private money. I was able to raise a little over $2 million in new funding in less than 90 days in this world of private money. And Jordan, since that time, I've never missed out on a deal for not having the money.
And that's a great, now, I love that. And I want to dive a little deeper into that because, and this is where I'm going to put my hand up and show my ignorance. And get a little teaching myself. So when I look at our customer base, in smartphone, for instance, we've got, thousands of real estate investors that use our platform, and I would say they vary from experience ranges, right? There are a set of customers who have multi-state large operations that are, what I would class as really scaled businesses and mature businesses. But there's also a lot of people who are at the newer end and trying to build a scaled business. At what stage of an investor's journey can they start looking at private money? And, is there certain criteria that's needed?
That's a great question. So in my community, I've got real estate investors that have never done a deal before that are raising private money. And I've got members in my community that have already got a portfolio of over 100 houses in their portfolio and have already raised private money, but they're looking to scale their business and raise even more private money. And so with that, the thought comes to mind to share that unfortunately, a lot of real estate investors that have been around the block for a little bit, they have heard it said Just get the deal under contract and the money will show up. And I'm sorry, that's not the way it works. That's not the way it works. I practice and I preach. Get the money lined up first without having any kind of deal attached to it. Just share your opportunity as to what you're offering. And once they tell you they're in, then you come back to them and you give them the good news phone call, is what I call it. And you get 100% of your deals funded because you're not bringing a deal for them to fund that doesn't match the criteria that you already taught them and you already shared with them. And so it just seems to be common sense to me that it's just a whole lot easier to be raising private money when you don't need it for a deal than versus when you do need it for a deal, because desperation has got a smell to it.
Absolutely, it has a smell to it, and you can't really, once you burn that desperation bridge with someone, you're never going to be anything but viewed as someone who's got the taint of desperation on them. Let me ask you, is it fair with that kind of model? Are you treating it, again, I'm going to put my hand up and claim and show my ignorance, so my community doesn't have to put their hand up to be ignorant. When I hear what you just said, I think of kind of like a line of credit at a bank almost. I know it's not a bank, but where I know I've got a $2 million line of credit, for instance, that I can draw on. Is that the type of deal you do with private money, or is it every deal I have to get? I have to kind of get approved by it, or do you build up credibility over time so that you then simply have that line of credit the more you've returned?
Yes. Well, I'm glad you brought up that analogy, because like in my case right now, I've got approximately $1.5 million in private money, what I call sitting on the shelf, waiting for the good news phone calls. They've got it there. They want to deploy it. They want to loan it out, but they're just waiting on the next deal, the next phone call. So that's a great comparison of thinking of what you have available is a line of credit that you're able to pull down on when that next deal comes along. Great analogy.
And so then, most people will. I would assume most people are going to use this for fix and flips. I mean, that's got to be the standard of or the standard single family housing type version of that. And I'm sure multifamily and larger can be done as well, but those tend to be bigger deals, chunkier deals.
Yes.
And so in the case of a deal, just talk me through the sort of a standard timeline and a standard structure. If I'm using, I've found a house, I want to flip it. I know it's gonna, I'm gonna buy it for, let's give round numbers because I can't do math. Let's say I want to buy it for 300. I want to spend 100, and I want to sell it for 600.
Yep.
That's relatively fair of a set of numbers. So and that's going to take me, let's say, 6 months to do all that.
Mm-hmm.
So what's the private money deal look like if I need to finance that 400 to be able to do this? So what kind of structure am I looking at?
Sure. So part of the structure is I advise not to borrow more than 75% of the after repaired value. Now, I didn't say 75% of the purchase price, because we're not doing loan to value on purchase price. We're doing loan to value on after repaired value. That's why in this world of private money, Jordan, I always bring home a big check when I buy a property. I'm bringing home that big check because, number one, I'm buying the property at a deeply discounted price. And secondly, for the renovation or the rehab, I'm going to be bringing all that money home when I purchase the property. So in this world of private money, there's no draws, right? I'm getting all that money up front. And of course, my private lender is looking to me to renovate that property. And of course, I'm going to, because I can't get the after repaired value unless I do. So here's a nice little double check on the structure. And so here is what I call a writer downer. All right. So when you're renovating a property, if you can't bring home a big check when you purchase the property and you're not borrowing more than 75% of the after repaired value, you're paying too much for the property. That's a double check right there. If you can't bring home a sizable check, at least all the renovation money and some more equity on top of that, you're paying too much for the property.
So that's almost a sanity check, for a double sanity check on when people are looking at offers and looking at how, I mean, having been involved in this for a decade, and weirdly, I'm not an investor myself. I've just been involved in it for so long. I feel like I know I could probably put a deal together pretty smoothly. But so that's a secondary check for when you're looking at a property. You do your comps, you look at what you think the ARV is going to be, you look at what you think the rehab needs are. What are you going to spend? What are you going to need to spend on this to get it to sell for that ARV? And then that should work you back to what your maximum offer is. And what you're saying is, as a doubles check on that, is you're going to compare it against that 75% rule. And if they all align there, you've got a good deal.
Absolutely. The formula that I use is a cousin to what the industry calls the Mayo formula, maximum allowable offer.
Mm-hmm.
When you're paying all cash using private money, I take the after repaired value. Now, this is only when you're paying cash using private money or your own cash. So I take the after repaired value and I'm going to multiply that times 70% if the after repaired value is less than 300,000. If the after repaired value is more than 300,000, I want to multiply the after repaired value, times 80%. Then I'm going to subtract from that the estimated repairs, right? And then after that, I'm going to subtract an additional $10,000 for the unexpected. He's called Murphy. Murphy shows up in every house. So I'm going to subtract an additional $10,000 if the after repaired value is less than 300,000. If the after repaired value is more than 300,000, I'm going to subtract an additional $20,000 from my offer, and then that gives me my maximum offer that I'm going to make. So just to recap that formula, the after repaired value, and this is when you're offering all cash, after repaired value times 70% or 80%, depending on the after repaired value, less estimated repairs, less either 10,000 or 20,000.
Murphy.
Yep, that's right, for the depending on the after repaired value. And that gives me my maximum offer. What I love about that formula is it takes all the emotion out of your offer, because emotion does not calculate, should not calculate the offer. The math, it's the math that calculates the offer.
Yeah, you know what? As you were going through that, the first thing I was going to follow up with you to say was what I like about that, and what I've always liked about people who do it well. When I watch really professional investors, the emotion's always out of it. It's always the numbers. And whether they like an area, they don't like an area, they like the house, they don't like the house, they like the people, they don't like the people. The question is, does the money stack up? And do the numbers work? Now, I want to ask a follow-up question on that formula, though. So when you say if it's over 300, the ARV is over 300, you times by 80. If it's under by 70, I think that was it.
If it's under 300, then I multiply times 70. If it's over 300, I multiply times 80. Mm-hmm.
And is that specific to a market, or do those numbers change? Because there are some markets where you're not really gonna get that many houses that are under 300, in some markets. So what's the criteria in this 300 rule, what you have? is that very specific to the type of houses or the markets you work in? And can that fluctuate based on the market someone's working in?
Yeah, it's just a matter of how big the number is. So if if the after parent value is over 300,000, which is in most places now, right? Those are bigger numbers. So I can have a smaller percentage margin and still have numbers that work as far as an anticipated gross profit. So that was a long answer to saying that formula works no matter where you are and what the market is.
Fair enough. Fair enough. And then, when let's step back from the sort of nitty-gritty money for a minute, because I love for me, I love the pure math element of this, not because I'm good at math, because I'm terrible at it, but because I absolutely I am a systems guy. And, for me, numbers rule when it comes to these things, and numbers don't lie either. And you can lie to yourself about numbers, but numbers themselves don't lie. And so I really like that approach. But if I take it back and think about an investor's journey, because most investors will start out, and real estate's one of those wonderful sectors in some ways where almost anyone can get started. Almost anyone can get started. And whether you're, bird dogging it or, just getting started that way, or you start with a one wholesale, whatever. When people look to get into the flipping model, what stage of maturity do they need to be in to get private money, to be, because private money is, I'm assuming, is a lot of it's based on your reputation and trust at some level. I mean, there's going to be credit scores potentially and things like that. But the truth is that's bank stuff. Private money is going to probably be on reputation and their belief that you are worth the risk. So if I was getting started into this, if I wanted to look into this, I've maybe done one and now I want to do two and I don't have that cash. What's a way I can set myself up to be doing that?
Yeah. So a couple of thoughts come to mind. First of all, and here's another writer downer. If you are borrowing the money, the private money, and if you don't pay the private lender, the property does. If you don't pay the private lender, the property does, which means you're not borrowing unsecured money. You're giving them a mortgage or a deed of trust. They'll actually make more money if they get the property than the interest you pay them. But let's face it, they don't want the property. They don't want the property. They want to be a passive investor and just get a really, really nice rate of return in interest. So if you're brand new, what can you do? A couple of things. First of all, partner up with somebody that knows the business, for goodness sakes. Don't start in this business alone and by yourself. And then secondly, you can leverage your past experience. You might not have been in real estate before, but what have you been in? What have you been successful in? Are you a person that is proven to follow through on what you say you'll do? Have you been successful in a previous career, right? So you can leverage that past experience as you're moving into a new model. But even if you've got a great past experience, again, I want to emphasize, if you're brand new, then partner up, get the mentor, get the coach that can make sure that your deals are being overseen and looked at before you dive in.
Now, I'm sorry to interrupt this amazing conversation, but I wanted to make sure you knew that Smartphone, the only phone system built for real estate investors, connects to the best-in-class real estate investing CRMs. And because, as it's my show and I am co-founder and chairman of Smartphone, I got some great deals for you. Click the link and take advantage of 5,000 minutes free calling with Smartphone, the only phone system built for real estate investors. Click and call. Close more leads. Back to the show. I that totally makes sense. And you know what? It also, I should have thought. Of course, the asset itself is a cover. The asset itself is a cover. I mean, to your point, they don't want the asset, but at the end of the day, they're going to have the asset if you can't follow through. So it's not exactly like, it's a secured loan. It's a secured amount of money against an asset that's worth something. So of course that the de-risks it for them, and I should have thought about that if I'd
Yeah.
done that.
Well, private money, it's all the same money regardless of the asset class you're using it for. It comes down to a matter of how do you structure the deal. So like if you're raising private money, if you're looking for investor money for say a multifamily, a larger, self-storage, a larger project, then you're not going to be doing what we call one-offs. Everything I do in single family houses is a one-off. It means I've got a private lender or two or three, and that asset is backing the debt. Everything we do is called asset-backed debt. That's why the Security Exchange Commission, the SEC, does not regulate what we're doing on raising money for these deals because we are backing that debt with the asset. But now, if you're going to raise money for a fund and have a private placement memorandum, then you're going to need an SEC attorney, and the SEC is going to regulate you for investors to be investing in that fund. It's all the same money, but it's a matter of how it's structured and whether you're doing secured debt or non-secured debt.
That totally makes sense. And, so I suppose there are two things, or there's a couple things I want to now push on to in terms of the conversation. The first is, and I suspect these two will go together, but I always think, well, what can I do to help our customers at Smartphone and the communities that we built there? What can I help them to get in their real estate journey, and how can I help them be more successful? And this, I think, obviously, funding is an enormous part of this journey. And it seems very clear that you can get access to this relatively, early, but most people won't know how to begin that aside from the partnering elements. So my memory of when I did my background research on you before the show, and no, not only is there a book, but you also have a community. You have a program as well. Can you give us a bit of an insight as to of what kind of program it is and how, what's that going to help people, how is that going to help people get started?
Sure. So I have all different levels of engagement with my community as to how we work together. So one part of the community is called the Private Money Academy, and that's a monthly membership that is only $37 a month to get in the membership. That's nothing. And so I go live on Zoom for the Private Money Academy community twice a month, second Wednesday, fourth Wednesday of each month at 4 p.m. And that's where we talk private money, and our members can ask questions and they share deals that they're doing. And for your community, Jordan, I'd invite your community to come check out the Private Money Academy the first month for free. They can do that at jayconner.com/trial. And I'm an ER, not an OR, JAYCONNER.com/trial. And that'll give you first 30 days. The membership itself has got great content and training by myself as well. And before we end the show, I'm going to offer my book, national bestseller, Where to Get the Money Now, that breaks down step by step the entire process of raising private money without ever having to ask for money. There's no selling, no begging, no persuading, no chasing. It's all about offering an opportunity and diagnosing if somebody has a problem, i.e., not getting good rates of return on their lazy money. So in this world of private money, I'm not looking for rich people. I'm looking for just ordinary people that have got investment capital and or retirement funds that they're just not happy with the returns. And so, you can offer a possible solution to that. And when I send out the book, I'm also going to include 2 tickets to my upcoming Private Money Conference, which is an in-person, live 3-day conference that your audience can attend as well.
Fantastic. Well, that's fantastic. I appreciate that. And what I'll do to make sure is I'll make sure this goes in all the publicity, the notes of the show, podcast, but I'll also send that out to my community inside a smartphone. Because we've got a lot, as I said to you before, we got thousands of real estate investment companies, that, and a lot of them I would class as the starting to scale companies, right? The people who are kind of moving on and trying to do more and more deals, and to me that's where getting involved with private money starts to really come into its own, because it allows you to accelerate your work as well, because you're not sitting there. You've got access to capital to do the deals that you're going to make money off of.
Yes, absolutely. That'll be great, Jordan. Thank you so much.
Now let me ask. So I'm gonna sidestep a little for a second, and I'm gonna geek out a little. I'm sure our mutual friend Kenner, will be happy about this bit. But in fact, Kenner was just on the podcast just a couple days ago. So part of what our conversation was talking about was taking emotion out and focusing on the numbers, and I'm fully with that. And I also see, as someone who is deeply involved with AI right now, as I am, I really see some of these, whether it's underwriting or whether it is calculating deals, like what we were talking about using ARV and all that. AI is perfect for this, because it can do all of that work for you as long as you give it the boundaries. Where do you see, in this brave new world where we no longer where anybody can get technology to do these sorts of numbers for them, where do you see this going? How do you see it going to be? How do you see it as a help? How do you see it as an accelerator? What do you see when you look ahead? Because you're deeply involved with the funding side of things, with the money side of things, and I would assume this is going to only improve that. But what do you think?
Well, at this stage of the game, I would say be careful. And here's what I mean by that.
Please.
So I was playing around with Chat GPT a few weeks ago, and I typed in to Chat GPT, and I gave it parameters on figuring the maximum allowable offer, and it came back with not good information.
I love it. I love it.
With not good information, and I wouldn't have known it was not good information unless I'd been in the business for this many years. On the other hand, I just finished paying a software developer to develop an AI software. So I have a collection that's called the Private Money $1 Million Script Collection. So I have 11 different scripts that I have written and I use for having conversations with potential private lenders. But then in addition to that, I said, you know what? Not everybody speaks in my voice, right? We all have our own voice, and we need to have our own unique voice. So I had a AI software developer create the AI private lender script generator, to where the AI asks specific questions of you, and then you give answers. There's only 5 questions, and you give answers based on your business model. Then the AI generator, private money script generator, creates the script in your voice based on your business model. That is working beautifully. I mean, that's fantastic. So, how do I summarize that? I think as far as math goes, I think as far as scripting goes, email follow-ups to potential private lenders, text follow-ups to potential private lenders. AI is going to become more and more involved in all those activities that we do, but don't rely on AI only. I mean, ever. I mean, as smart as AI is, AI will never be able to, in my opinion, duplicate human experience, right? So we want to keep the human element and the human coaching and the human experience in hand with what AI can do for you now and in the future.
All right, well, I think we may I think you, Kenner, and I may have a nice conversation in March if we're seeing each other in March in Tampa because there's definitely, I mean, we as a phone system we've got now, we've launched voice AI agents and it is to the point now where genuinely it outperforms the human in a number of ways consistently on calls. It's quite creepy, and what I'm looking forward to in the future, because your point is absolutely valid about either A, hallucinations, or B, just being bad at math, because which it shouldn't be, but it sometimes is. But having now trained and put guardrails up, we call them guardrails in our system of what it's not allowed to do, what our agents aren't allowed to do. Like they can't lie, they can't make shit up. So pardon my French, but they have to always admit to being AI. They can never lie about that in our agents, like, right? I do think, however, having built systems now for so many years, I think we're getting to the point where AI is going to be able to do the math and where you're going to be able to set your criteria up, and agents genuinely, I don't think we're very far off where an agent could actually close a sale and make the correct offer based on it figuring it out with guardrails and with math. I think we're getting there. We're not there yet, but it's getting there. And that's exciting and terrifying in equal measures.
Yeah. Oh, I agree with you. I mean, you give the formula, you give the calculation. I mean, I'm using an AI agent right now. Her name is Bailey. And when we do a direct mail campaign, Bailey answers the phone. And Bailey identifies herself. She says, I am an AI agent for jbuyshousesfast.com. May I ask you a few questions? And it's really interesting with the tonality and the inflection of the voice that if Bailey didn't identify herself, and I will always, like you, have her identify herself as an AI. Actually, she calls herself an AI assistant.
Yeah.
AI assistant. And she identifies herself as that. And you know what I find to be interesting? Out of every 5 phone calls that AI Bailey answers from our direct mail campaigns, 4 out of 5, my acquisitionist gets an appointment to talk to actually talk to the seller, and the entire conversation is transcribed. And I'm not so sure, Jordan, if the owners of properties, the sellers of these properties, don't feel more trustworthy talking to an AI assistant than a real person.
Than some schemy guy. Yeah, you know what? I don't look as a guy who now has launched a whole marketplace for AI agents. A couple things to follow up on. Number one, I love that you're talking about her, and I know that sounds weird, but I am banging the drum right now. And actually, last week when I was in Jacksonville with our mutual friends and family, I banged the drum on this. Where in smartphone, our agents, we class them as labor. We don't, they're not software features you turn on and off. These are roles you hire for to supplement and go alongside your human roles. They're just a new class of employee, essentially. they're not they're a coexisting type of employee, and people have to start thinking about it like that, because that's where you really can take advantage of it, like you are. And to your point as well, like, with our, when I look at the agents now, and our agents actually have full memory of all the conversations they've had with someone. So, like, genuinely, our agents can go, if you call back our agent would be like, "Oh, hey, last time we talked, your wife was sick. How's everything going?" And like, it's that good now. And I think that most people are not finding it that a friction to talk to AI if it gets them where they need to go.
Yeah. Well, I mean, people that respond and dial the phone number, they're looking for an answer to
I need help.
to their solution, And what I love about Bailey, our AI assistant, Bailey never has to go to the bathroom. She never has to take a vacation day. She never has to take a nap. She doesn't sleep.
Never in a bad mood. Never had a bad mood.
She never gets sick.
Kids.
Yeah.
You
said a very, very important word a few minutes ago, and that was consistent. Bailey is always consistent.
Rock solid, consistent. And as you clearly have done, what people don't understand, if they've never used an AI assistant, i.e. they've never hired an assistant like this, agents like Bailey aren't based on scripts. AI agents don't work like scripts. They don't work off a script that they run. They are trained in sales skills and soft skills. Like, I train our agents for open questions when they're asking about property, to ferret out information. AI agents aren't script based, which is what makes them powerful, because they have conversations instead of run through a script. And clearly Bailey does that, because if she's converting 4 out of 5 calls to an appointment, it means that people are responding, they're accepting it, and they're getting to the point where you need them to go. And they're doing it 365 days a year, 24/7, exactly the same, with exact same consistency.
That's it. I love it.
Fantastic. Well, I'm looking forward to. First of all, I appreciate you for coming on and sharing the gives that you have, the generous offers that you've given. I'm going to make sure that not only we put it in the notes, but I'm going to send it to the whole community separately to make sure they can take advantage of it. And so I really appreciate you coming on. I'm looking forward to seeing you in March, because I think we're going to be in the same room together in March. I'll turn it over to you to close out. If there's any final thoughts, as well as how, just a reminder to people about what you're offering and how they can get in touch with you.
Sure. So I'm going to give your audience, Jordan, a special website. So Where to Get the Money Now, the book, I'll autograph it, express mail it to you. I'm going to include 2 tickets to the Private Money Conference. You can get it at $20 on Amazon, but don't give Amazon $20. The book is free from my office. Just cover a little bit of shipping, and you can pick up the book at www.jayconner.com/book. Again, that's jayconner.com/book, and we'll rush it right out to you.
Well, that is a fantastic way to end. Jay, it's been an absolute pleasure to have a chat with you today. I appreciate you coming on, and I wish you the very best for the rest of the day.
Awesome. Thank you so much, Jordan. God bless.
Thanks for listening to another amazing episode of That Real Estate Tech Guy. Head over to thatrealestatetechguy.com to check out all episodes and get special discounts on tons of awesome real estate technology platforms.